Hello, everybody. I hope you guys are doing well. As you probably know, my name is Tony DiUlio. I'm an attorney that handles first-party property claims and property damage litigation all over the country, based out of Philadelphia. And putting on these series as part of an opportunity for me to give back. It's totally free. They're always available on YouTube, on our Facebook, on our website, really, all over the place, so that we can try to educate the industry to grow together. There is a lot of issues that come up in this industry that education could fix, and I like to try to give back as much as I can with these free webinars. So really like to thank you for participating in these First Party Fridays. Today we're going to be talking all about commercial claims coverage, specifically the business income and extra expense coverage that can complicate people's lives quite a bit. So we're here to try and simplify it a little bit, teach people about what's in the policy, and go through all of that. It's a pretty long class today. I still want to be done in an hour, but I've got a lot of information to go through, so I want to jump in to get through this. As always, there is a live chat that I'm able to review and can pop up commentary during this with any questions you guys have. One of the benefits of actually being on here rather than watching a recording later is that you can ask live questions as things come up. So please feel free to ask any questions you might have. I will be sure to address them, and we can jump into this. Oh, excuse me. Going back to the side-by-side, I think it might be a little bit more engaging this way, but although I'm actually realizing the wrong slideshow loaded up. So I'm going to talk about this a little bit without the slides as the slides get loaded. I do apologize about that. So with commercial claims, as with every insurance policy, commercial claims can get a little complicated and be a little bit different when it comes to what people expect and how those claims are handled. So the first thing I tell everybody in every single one of these claims is read the policy. You absolutely must read these policies. As important as any homeowner's claim, residential claim, or otherwise, you need to make sure you read these insurance policies for commercial claims, because commercial policies can be complex. There's a lot of other factors that go into it. So you need to make sure that you're going through that and reading and understanding that policy. If you haven't read the book, When Words Collide, it talks about RTFP, read the effing policy. And I stand by that over and over, telling people that they need to do that. I will start one of the announcements that we're going to be making. PAGPS, the Public Adjusters Greater Philadelphia Summit, is finally in the works. The website is up and ready for signups, and we have a call for speakers. If you know of somebody who wants to talk, if you have any recommendations of topics that you'd like to hear, or you yourself would like to present something, you should please email me with either your recommendation for someone else that we can reach out to, or your own topics and what you'd like to talk about. We would love to have you. It's an amazing conference right in Philadelphia. It's the largest one in the tri-state area. I've been really proud about putting this thing on. So please reach out and let me know if you'd like to participate. You can go to pagps.co to sign up, and we would love to hear from you. I'll pop the slide up here because I made them, so I might as well have them up. That's the who am I. I'm not going to worry about that at this point. I will say the disclaimer. I've got a lot of videos out there now, and not every claim is perfect. Not everything that's handled is perfect. It doesn't mean a claim is denied. These are recommendations and not requirements when it comes to claims. So you don't need to use any of this as evidence against me for if this didn't happen in one of our claims. So here's the information for PAGPS, October 15th through the 17th. For anybody who came last year, the first day, it's just registration, and we do a happy hour that we sponsor from my office, where you get to meet myself and people from my staff, have some drinks, go out for the night. It's a good time, and we offer CE credits. There's going to be between 10 and 13 this year, and would absolutely love to have you there. Like I said, we're asking for speakers. So if you need, please reach out and let me know if you're interested in all of that. All right, so we've rushed through all that beginning stuff, and now that we've got the proper slides up, let's dive in to business income and extra expense. Don't let it be a liability for you. I was trying to use as many accounting terms to be clever there as I possibly could. Business income and extra expense coverage can be complicated. A lot of commercial insurance policies that are issued to your insureds will use the ISO forms. If you don't know, ISO is the Insurance Services Office. They provide forms for clients who are different insurance carriers that they're able to use and ultimately be part of their policies. Some carriers do what's known as modified ISO forms, so that they take this, they make it a little personalized for themselves, change it around. It's really, really, really important, guys, to read these forms over to see if it is a modified ISO form. You can usually tell because the ISO number won't be the same. It won't be the 00300402. But if you're not looking for that and you don't see any kind of language about it, you should read through to make sure that that is the case. Mike, you asked a good question about PAGPS, asking about how the parking is and whether or not the vice president will be there. For those who don't know, last year at PAGPS, we booked a hotel for the event, and we were not told that Kamala Harris was going to be there that same weekend. So it was a little bit crazy. Parking at the casino is free, and there will not be a vice president there. So absolutely a lot easier for people. It's one of the reasons we chose that location. All right, sorry, back into the fun stuff. So when you're looking at these forms, you're going to find out that a lot of your clients have this ISO form as their business income and extra expense coverage form. But it is not the only way that this coverage is offered. It's what I'm focusing on because it is by far the most common, but make sure you're checking your policy to see where the differences are regarding this type of coverage. So you're going to note that this one coverage form for this one area it's 9 pages. It's significant. There's a lot of information in there. It talks about what business income is, what extra expense is, the limits within those coverages, and they actually provide some additional coverages and conditions within that section that need to be reviewed. For example, they have their own co-insurance provision contained within the business income and extra expense form that outlines exactly how that is calculated and reviewed. But that can be really important if you've got a co-insurance problem. So just recognize that there are these different sections that can come up that are specific to areas of coverage and specific to business income and extra expense. So what is business income? We look at the policy itself for these definitions, and we'll talk about the language and kind of what it actually means in layman's terms. But this is the definition that is provided within the policy. Business income means the net income, and it's going to be important. I'm going to say this a few times. Net income, which is the net profit or loss before income taxes that would have been earned or incurred, and continuing normal operating expenses incurred, including payroll. And then they add this thing about manufacturing risks, about the sale of products. So when you're looking at this, the really important aspects that you're trying to focus on is the fact that this is a net income calculation, not a gross income calculation. For those who don't know, net income is after those expenses are taken out, and it's what you're left with from the profits and the money earned from the business. So what are you actually paying for? We will pay for the actual loss of business income you sustain due to the necessary, quote, suspension, end quote, of your operations during the period of restoration. We're going to talk about all these defined terms. Defined terms and policies are often quoted as they are in here. It must be caused by direct physical loss of or damage to property at the premises, which is described in the declarations, blah, blah, blah. Here are the really critical aspects. Number one, it must be part of the necessary suspension of the business. I've got another slide on the suspension, but that's critical aspect number one. And it must be caused by direct physical loss. This was hugely litigated with COVID. When COVID happened and you had the shutdown of businesses as the result of the pandemic and the government orders, there was a lot of fight, and almost all of it hinged on this issue where the courts came back and said that unless you can show the virus on premises, that you don't have any direct physical loss. And there were other courts that said viruses aren't actually considered direct physical loss. For what it's worth, by the way, I disagree. I do believe viruses are direct physical loss. And I know that, by the way, because the policies contain exclusions for viruses. If the policy only covers direct physical loss, why do you need to have an exclusion for something that wouldn't even constitute a direct physical loss? I digress. Point is, you need a covered event to trigger your business income coverage. You're not getting coverage just because another business opened down the street and you're now losing customers. So you really need that direct physical loss as part of it. So this is what you want to note. The measure of damages is net income, not gross income. The reason this is so important is if you have clients who are, keeping their books pretty low, maybe they're a cash business and they're not reporting everything. I'm not going to talk about the rights and wrongs of that, but when it comes to insurance, you're going to have some real issues proving your net income if the books don't support that position. You also need to consider what is the continuing payroll expense, because that can often depend on what is necessary to maintain the business in its normal operations after the loss is over, the people that you need to make sure you keep around and aren't replaceable or kind of easy to find someone else to do, and maintaining that payroll. So all of these factors can get really contested when it comes to a business income claim. And one of your responsibilities is to answer the why question. In most of our industry, and this goes across whether it's residential, commercial claims, really doesn't matter. One of the most important jobs that a representative for an insured can do is explain why. So often I see claims, and obviously I see the worst of the worst because of the denied claims of the things that the carriers don't want to pay for. But so often the claims I do review, the adjusters are never explaining why. They're saying things like, we're making a claim for this coverage and this damage to the property and for these repairs. But they don't explain why. They don't have anything in writing or even a good explanation for it that's ever presented to the carrier. You need to be doing a really good job of explaining the why. And it's just as important here with commercial claims as anywhere, where you need to explain why these expenses are being incurred, explaining why that payroll is still necessary. All of that type of information is really, really important. The measure of the damages is often based off the tax returns that we talked about. So when you have those companies keeping the low profits, you want to keep that in mind when deciding what to pursue for these claims, because you're going to have issues if the tax returns aren't really supporting the position that you're taking. The pause in the business must be necessary. Again, we're going to talk about the suspension aspect, but this isn't something that you can come in and say, oh, well, look, they just want to shut down during this because they're concerned about a client coming in and the appearance of what that'll look like for when a client comes in. Let's say it was a hotel and they've got to renovate some areas of the lobby, and they say, I really don't want clients seeing it that way. I'm just going to shut down and claim the business expense and loss of income. So sorry, that's not going to justify it. It needs to be necessary suspensions. And most of the time, that's not going to be considered necessary. And the other factor that you really need to consider from this, and we will get into a little more detail when we look at the language, is the period of restoration. You don't have unlimited time here, guys. Just because you've got limits that might extend through 2 years, you might have a dollar value limit, or candidly, you might not have a limit on time for how long this goes. It's just based off of that period of restoration. It will still be a limit. You can't use all the time in the world, and you want to make sure that the repairs are moving reasonably to the best of their ability. All right, so Let's dive into some more language like when this triggers. And I told you that it has to be a necessary suspension. So the policy does a good job of describing what that suspension actually means. And I think it's broader than what most people recognize. When most people recognize a claim for business income, they think the business needs to be entirely shut down. That isn't true. As you can see here under the definition for business, a slowdown is enough to trigger business income coverage. Suspension means the slowdown or cessation of your business activities, or that a part or all of the described premises is rendered untenable if coverage for business income, including rental value or rental value, wait, for rental value, I have no idea why it says rental value twice. This is a screenshot from the policy. I think that's pretty poorly worded. So what that means is the slowdown can be enough to trigger. Let's say you have, easy example that I think everyone would recognize is a hotel claim. Half of the hotel is unrentable. Great, we can make a business income claim for that. But if you have a situation, maybe you're an entertainment company and you have certain areas of your property that are no longer usable, and as a result, you can't do your showcases to show off the talent that can be hired for weddings or that kind of stuff, and you start to lose some of your business. The office side of that building might be perfectly usable, just not the stage. You can make a claim for that business income because of the slowdown in business from not being able to do that. These are all things that you should be thinking about when you are putting together the business income claim for these insureds. To do that, you want to make sure you have a good conversation with your insureds about how the business has been since this loss has occurred. Has it been business as usual? The numbers are all the same. Have they seen a drop off, right? If they've seen even a 10, 20% drop off in sales, or that truly the net income number, then that's something you want to start talking about as to figuring out the why and seeing if it's something that you can claim as part of the insurance loss. Beyond that, we get to extra expenses. So we have one side to start all this with the business income loss. The other side is extra expense. I will fully admit, when I first started doing this, and I learned about all this the insurance world and everything that was coming into it, extra expense felt a little bit confusing to me because I never really locked in on what it was talking about. What were the really things that could be covered under extra expense versus things that are just associated with the loss itself, right? Tarping the roof, for example, is that an extra expense or was it associated with the loss? Kind of never really made sense in my head for a while until I started doing this a whole lot more for a whole lot longer. So hopefully we can talk about that today so that you understand it more. Extra expense means any expense to avoid or minimize that suspension time, right? So that to keep the business going, to lessen the loss on the business income side is the extra expense stuff. So it's got to be tied to saving the carrier money on the business income payment. That is what constitutes extra expense. It's kind of the simplest way I can put it. If it involves things for just doing the repair to the property, you're probably fitting it in there. Obviously, the gray area becomes, well, doesn't repairing the property help avoid and minimize the suspension of my business? And the answer is yes. But it's really the concept of the things that are truly related only to shortening that time, like renting another space that might be available to do presentations or make sales or whatever you might need, those types of things. And I've got a list that's going to be coming up. So it's all of that to avoid or minimize the suspension or minimize the suspension of business if you cannot continue the operations at all. All of that constitutes extra expense. There is no kind of definitive list of extra expense. I'm going to give some examples, but know that this is something that is really up for interpretation when it comes to what fits in that area. And it's one of the things that you're going to be fighting potentially on some of these claims. The extra expense definition continues and says we will also pay extra expense to repair or replace property, but only to the extent it reduces the amount of loss that otherwise would have been payable under this coverage form. So what does that mean? It means that if you can do something to fix the property in a way that it has nothing to do with repairing the loss, but maybe you've got, and this is kind of the easiest example I thought of, in that situation where you're an entertainment company that does wedding bands for weddings, right? You can bring bands or DJs, and you have an area where you can do a presentation. That stage area with the presentation has a loss, you can't use it. Well, you happen to have a warehouse space that's part of it that you're not really using much, and you want to convert that area to a stage to help lessen this cost. That would be something that could fit under this definition of, all right, well, it's repairs to the property, but it's not really associated, and it wouldn't otherwise be paid for under my coverage A property coverage. That could be considered an extra expense because you're doing it to try and reduce the business income loss. I hope that makes sense. It's kind of the easiest example, but I'm sure there are others. If you've got examples that you're curious about in this area, whether you want to ask or share knowledge of situations that you've had this, please add it to the chat. It's always beneficial for everybody. All right, so there are limits and to all of this, but I want to put it in layman's terms on how we're really exploring all of this. Extra expense coverage is the additional costs that you wouldn't normally incur, but that you need to spend to keep your business running or get it back up and running after the covered event. I know we've talked about it, but I always like to have these slides for people who want to jot down notes or screenshots, do whatever they do as to the actual language. It's avoiding or minimizing the shutdown. That's the key here, guys. You're avoiding or minimizing the shutdown and continuing your operations. It's as the key point says down here, you only get reimbursed for expenses you wouldn't have had if the loss hadn't occurred, and only during that period of restoration. All right, here are some examples. If you need to any relocation expenses, we talked about moving to a different venue to continue to sell items, for example. That relocation expense often falls under extra expenses. Equipment rentals or leases, overtime wages, because you want people to be working overtime to get your business back up and running. That could fall under extra expense. Temporary staffing, if you need to move locations and bring additional people in to help with that, that can be an extra expense. Expedited shipping. This is a really big one, guys. If you have a situation where you've got a contractor who has to order parts and say, look, I can, the normal standard shipping gets this here in 3 to 4 weeks, or you can pay an extra expense to, get it here in 2 to 3 days, have them pay it. Have them pay that extra, for that rush job to get them back into this property, because that can still be a covered cost. Increased utility costs, because you might need to bring in additional generators or additional AC units if something breaks with an AC in the property, things like that. Setup costs for temporary operations, additional security or monitoring, vehicle rental, that could include things like U-Haul, professional fees to minimize downtime. Again, this list is by no means exhaustive, and there will always be situations where something might not fit exactly, but this kind of gives you the idea of what types of things are you looking for when trying to analyze, is this an expense that I incurred to shorten that period of time that my business will be down, and that the carrier will be paying for the business income. If you've got any questions about that, let me know, but hopefully it makes sense. So within this business income and extra expense coverage is often where civil authority coverage will trigger. Again, civil authority came up extensively through the COVID litigation, but otherwise, it is not terribly common. It involves situations where your business is shut down as the result of direct physical loss off premises. So most common situation would probably be a fire at a facility that might have some toxic chemicals, or even buildings with asbestos that have fires. They might shut down a block for some period of time. If you're in a situation where that is triggered under civil authority, even though you don't have the direct damage to your own property, right? There's no direct physical loss to your property, but there's direct physical loss to another property that causes yours to have to shut down. You can get coverage for that. Civil authority can get kind of complicated. Again, it's not terribly common, so I don't want to spend a ton of time on it, but I wanted to make sure that we hit on it a little bit. What does come up, and I'm actually surprised at how often I've had people ask questions about this recently, because it never felt like something that was coming up, often is alterations in new buildings. And it's come up actually in the context of contents. But what this is in essence going through is saying that if you have business income and extra expense coverage under this form, you have new buildings or structures, even things that are currently being built, that were going to be used for your business. So let's say you were expanding, you have a restaurant, you were building a new area because business was going so well, that area has a fire and burns down. You've got coverage for the loss of business that would have come from that new area, the new construction, the new thing that you were doing. You've also got coverage for that under the policy. So make sure you're looking to see if you've got it, because that does come up in a surprising number of situations. Again, making sure you've got the actual direct physical loss to trigger all of that. There is extended business income coverage that it also is contained within these policies forms. And as you can see, it's business income other than rental value. If the necessary suspension of your operation produces a business income loss payable under this policy, we will pay for the actual loss of business income you incur during the period that, one, begins on the date, why am I having a hard time reading that? The date property is actually repaired, rebuilt, or replaced, and operations are resumed, and ends on the earlier of the date that you could restore your operations with reasonable speed to the level which you generate the business income amount that would have existed if no direct physical loss or damage had occurred, or 30 consecutive days after the date determined in 1A above. Well, what the hell does that mean? It means when you have a loss and you get up and running and you're finally up to speed, right? Business is running or can run as normal. There is often for businesses a ramp up time of getting back to where they were before. So it's not enough that you can be operational. You've got extra time with this extended business income coverage, if this is something your policy has, for up to 30 days, or when it gets back to its normal level of extra coverage. Restaurants are the easy one here, guys. You have a restaurant that shuts down. You finally get back to the point where you can be up and running. Your first week or two might not be as busy as it used to be, because everyone might not know you're back up and running, right? They might still think you're in repairs, you might be shut down, whatever the case may be. So you get that coverage for that built-in additional time. It can be really valuable for businesses like that, or retail businesses that have kind of a daily income when people don't know that they are open and up and running. Rental value is a separate area within business income and extra expense coverage. There's always carve-outs. I shouldn't say always. Lawyers don't use words like always, because nothing is always. But it is often its own carve-out and separately defined. And for rental value, they look at it beginning on the date that the property is actually repaired, again, to the ending on the date you could restore the tenant occupancy with reasonable speed. What that means for rentals: if you have a rental property that has a fire, you repair it, the next day a tenant could move in, but you might have some time to find that tenant, right? You might not have been able to get it whenever you first listed it a week or two prior because you knew it would be fixed. You've got time for even that downtime when the place is rentable but not rented for additional coverage under the rental value provision. Hope again that can make sense. And if you've got questions, please let me know. As with any policy, there are conditions that apply. You're never going to get away from it, and it is one of your responsibilities as the adjuster on the claim who's being hired to advise and assist the insureds in their insurance claim to advise them of those conditions. You never want to be in a situation where an insured says, "Oh, my adjuster didn't tell me that that needed to be done," because it is your responsibility to do that. You've got to let them know if there's something that is necessary that they're not doing to do it, or if it's something that already has passed that they should have done. You should probably let them know that that might cause some risk for them. So as with anything, there are conditions for this area. The reason I put this in is I want people to recognize that business income and extra expenses are appraisable just like every other aspect of an insurance claim. So when you send the claim to appraisal for the structure or for the contents, you can also have the business income and extra expense appraised. You're going to have issues, of course, in some states like New Jersey or others where they limit the scope of the appraisal to only what the carrier wants to pay for. But know that the fight can be had over appraisal for these values. It's not something that has to be left out for any given reason. Another one of the conditions, and there's others in here that I have not copied because there's some of them just don't come up enough to justify the time. But this one absolutely is critical. As we talked about, most of the time when you're looking at business income and extra expense coverage and determining the value, they're going to want to see your tax returns. They're going to want to see profit and loss statements if you've got them, your balance sheets, those accounting records. It is totally fair game for them to ask for that. I have had situations where clients, for one reason or another, don't want to turn them over. And I always have to explain to them that is your responsibility. You've got a responsibility to turn these over to the carrier because it's how you can determine the loss, right? It's an easy place for everyone to go to. So easy that they actually put it into the policy that they are permitted to inspect anything proving the loss or damage and examine your books and records. Notice it says books and records and not just tax returns. What that means is they aren't limited to just tax returns. If you have other accounting records, if you've got a box of receipts in a shoebox underneath your desk, that's all fair game because those are books and records that go to the business income and extra expense claim. You can also, it also says, also permit us to take samples of damaged and undamaged property for the inspection, testing, analysis. Not really relevant for this, but the last part is they can make copies of your books and records. So they're allowed to do those things. You really shouldn't come back and stop them. I will note it does say reasonably required. So if they want tax returns from 20 years ago, that's probably not reasonable, given some, honestly, I can't even think of a situation, but it does have to be reasonable. What I would tell you, 3 years is almost always going to be reasonable. 5 years is common, and I think you're going to lose the fight if you try to fight it. Things over 5 years ago, that's where it starts to become a little iffy and might not be reasonable, given some explanation from the carrier as to why they would want a tax return from 7 years ago. Excuse me. Loss determination. So this is how we actually figure out what the value of all this stuff actually is. The amount of business income loss will be determined based on, note there's multiple factors here, guys, net income of the business before the direct physical loss or damage occurred. Oh, great. That's fantastic. We're going to talk about what happens when you don't have that. But of course, that is a starting point. Number two, the likely, that's a critical term we'll also talk about, net income on the business if no physical loss or damage had occurred, but not including any net income that would likely have been earned as a result of an increase in the volume of business due to a favorable business condition caused by the impact of the covered loss or covered cause of loss on customers or on other businesses. I was trying hard to think about what would trigger that situation. It certainly hasn't come up in anything that I've actually done, but I wanted to put my head to why that would be the case. And what I've come to the conclusion of is short of, maybe you have a lot of goodwill from customers that they hear about your loss and end up doing something that would have increased the amount of your business as a result of that. But I really don't have a good example of when that part will kick in. If you guys have any, I'd love to hear them. It continues. We're also going to look at the operating expenses, including payroll expenses necessary to resume operations with the same quality of service that existed just before the direct physical loss or damage, and other relevant sources of information, including your financial records, which we talked about, bills, invoices, and other vouchers and deeds, liens, and contracts. Here's an important aspect that has come up on claims. This list doesn't have what lawyers love to use of including but not limited to. That language here, which if I were drafting this, I certainly would put in there, but other relevant sources of information really should be an including but not limited to. Here's what I'm going to tell you. Don't try to be smart by fighting that fight. I know I'm telling you it should be in there as including but not limited to. It's not worth the argument. Guys, our goal in this industry, I'm going to say our goal, from the side of people who represent the insureds, and candidly, it should be for the carriers as well, but our goal is to get to the true, honest answer. We shouldn't be hiding things from the carrier just because we think the result of giving it to them might be a bad one. We should be able to support our claim with all of the information. You don't need to be clever about, oh, well, this just says including these things, so I'm not going to give you, that X document that you've requested because it's not in this list. It's not worth the fight. Truly isn't. Unless there's a protected reason, right? It's confidential or something else. You really shouldn't be in a position where you're trying to hide that stuff from the carriers. So what does it all mean? It should be obvious, but when you're putting this together, you want to make sure you tell your clients from day one, document every penny you spend after the loss. They should keep every receipt and every invoice. If they're paying cash for something, they should get a cash receipt. What I tell clients, if at all possible and you're paying something in cash, I would also withdraw the money so you have proof of the withdrawal to support the payment. What I mean by that is you have a contractor who comes in and charges you $800 for a plumbing job and they want to be paid cash. Fine. Save money, pay them cash. I don't care. But go to the bank, do an ATM withdrawal for that $800 that coincides as closely as possible with the cash payment invoice. And it's great evidence for a court or for an insurance company to show that it was actually paid in cash. Because their question is always, oh, is this real? Did they really make the payment? And that helps to support it. When doing all of this, you really need to use a forensic accountant. There's no good way to do it yourself unless you happen to have an accounting degree and are or were a practicing accountant, but you should use a forensic accountant. They are worth their weight in gold. If you don't have a good one, I'm happy to refer you to someone, but they truly are invaluable. But here's what I want. I think all that's really obvious. But here's the thing I want you to understand is you want to get your accountant there first. You want to get a report to the carrier of the business income loss before they ask for an accountant to do it. It is always beneficial, at least in my experience, for the adjusters to be the one to first present that business income claim rather than trying to adjust their number up. It's a lot easier to just present your number to them and allow them to review it. As long as you're working with a good forensic accountant, it shouldn't be too much of a dispute over it. Although it does happen. I've been involved in a ton of these claims where there is a dispute as to the business income loss because of some unique characteristics. And we're going to talk about those. But on most claims, business income loss, it's not really an opinion. Because accountants are so number-based or so fact-based, it's really does 1 + 1 = 2 or not. Coming up with that number, there's not much of, well, I think it's going to be this and you think it's going to be that. Of course, there are variables, and it's in those variables that the fights exist. We'll talk about them, but growing businesses, right? What does that mean, and where does the opinion fall on a growing business? Newly acquired businesses, what does that mean for income? These situations can obviously create debate, but for just your average, business that's been running for 10 years, you shouldn't have too much trouble if you work with a good forensic accountant to get these numbers and get them done appropriately. The question, as referenced before, I'm going to go back just to show it again. Under 2 is the likely net income of the business if no physical loss or damage had occurred. The question of likely is always going to be a question of opinion, but with those records of a historic business that's been in place for a while, it shouldn't be too much of a dispute. But there might be factors like what payroll is actually necessary that can change this number around a little bit for what is likely going to be earned. So get your support for the necessity of those expenses and have that ready for the carrier when they request it, because they're going to say, well, why are you still paying Jane Doe on this loss? And you're going to want to have an answer of, look, Jane Doe is a talented hotel manager. She's been with us for 15 years. I wouldn't know what to do with myself if I lost her. So I absolutely need to keep her on the payroll and continue paying her while this loss event is in place, because if I don't, she's going to find a job somewhere else, and I'm not going to be in a position to reopen as quickly or reopen with the same quality that I did before. Great, good answer. Also, this includes the C-suite people, and that usually is going to be your client who's an owner of the business to continue to maintain that payroll. You will have an issue when it comes to companies that pay out in some type of bonus structure or some compensation package that isn't as simple as kind of a payroll check, but you can often argue those successfully as well. If you're a company that does distributions quarterly, for example, you can use those distributions as evidence or as continued income that needs to be going to those people, because that becomes an expected income for those people and should be part of those payments. Make sure you're taking all this into account and talk to your forensic accountant when going through it. So Mike has 2 questions here. The first one, I don't know why it's not popping up. I see there it went up. I see it blended in perfectly. Would that last one apply for a new business that had not yet started making money? I don't know which the last one was there, Mike, if you want to chime it in. But and we'll talk about this in a moment. With new businesses, you will need to be looking into historic values if you just purchased the business from the prior owner, or other comps for people in the area, things like that. And then the question that always comes up, because this applies for engineers and other experts within the case, is the cost for a forensic CPA covered by the policy? The short version is, so long as they rely on your CPA to do the job and they're okay with that, it is a covered cost under the policy. So you can put in those costs. Where you're going to hit a gray area and get conflict is when the carrier brings in their own forensic accountant as well. This is one of the reasons you want to bring your person in first, because you bring your person in, you present the expenses associated with that job to the carrier, all as reimbursable expenses. And then if they decide to bring somebody in, you at least have the argument of, look, we already did all of this. We've got an incurred expense as a result of it, and to present it to them accordingly. In addition, I've also successfully argued that even if their forensic accountant for the carrier did their own job, I have a forensic accountant, that's actually an extra expense. If I didn't bring that forensic accountant in, I would have had to do all of this work myself. It would have taken me 3 weeks going through this stuff just to try and make heads or tails of it. So instead, I hired a forensic accountant who can do it in 2 days. That saves time because it gets me an answer to what I need sooner, and it shortens, at least has the potential to shorten that time of how long my business is shut down to get that reimbursed as well. So you can use those arguments towards this. It is much harder when you bring your accountant in after the fact, and the only argument you have is the extra expense argument versus it being a covered loss otherwise. All right. Let me hide that so it's not covering the screen. I can't express enough, and it's why I've said it twice before, and I'm going to say it again, be able to explain why. Why did they have these expenses? Why are they doing it? Where is the evidence that it was necessary? Make sure you guys are getting that as often as possible. Unique issues. See, I was one slide away. Owner payroll. usually determined to be a necessary expense, but because you need to show that those expenses for your client as a payroll expense, whether it be that bonus structure that we were talking about or the distributions, make sure you've got the evidence to support that that is the regular payments that are being made to them and expected as part of the compensation package. New businesses. You're going to want to look outside of this particular business for those answers. If it's a newly acquired business, hopefully they'd have some due diligence that they've done and they've got the accounting records from the prior owner. That is common in the industry. So the insurance companies will often say, hey, can you send me the business records from the purchase of the business to take a look at those? Again, it's perfectly reasonable to request those. Hopefully your client has them. If your client doesn't have them, I've had situations, by way of example, where a hotel was purchased after a foreclosure from a bank. Because it was a foreclosure purchase by the new owners, there were no prior records. The hotel had been shut down for 2 years. There was nothing really to look at. In the hotel industry, there's this great thing called STAR reports. They're STR. There's no A, but people call them the STAR reports. STAR reports show comps for other hotels within the area as to how many rooms they're renting, what the average value is. It's ideal. It couldn't really be any better when you've got a business loss for a new hotel owner as to what that's going to be. It's not so easy in other areas of industry, but a good forensic accountant, again, can help you work through that problem. You've opened up a new restaurant. All right, well, let's see what kind of historic data we can find for other restaurants within the area to help determine what your comps are. The other part of this is also the future plans. Maybe you've just put into motion a 2-year plan to expand your business, and it comes in stages, and you're at stage 2 of 5, and you have a loss that occurs. That is something that can be accounted for in a business loss. It is not just the historic values, guys. I really want to stress this because so many businesses invest in that process with the understanding and expectation of the return that it's not unreasonable, and it's certainly likely that that will turn out to be favorable for the business, assuming they're doing their homework and doing it the right way. So you can make a claim for those additional damages that you would have seen because of your business plan. It is not good enough, guys. I really, really want to stress this. It is not good enough to just say, oh, I was going to do this in 2 months, so pay me for it. You're going to really need tangible evidence. Business plans, emails with other people within the business talking about the plan, showing something that things were in motion to make an expansion or some additional business build happen, and then you can make claims for that. But you're not going to just be able to go in and say, oh, I was going to do it, and expect that the insurance company is going to pay you more money as a result. If any of those issues come up again and you don't have a forensic accountant, let me know. Happy to do it. So how long do you get all of this? Like I said in the very beginning, business income coverage and extra expense coverage doesn't last forever. So we've got to talk about what your time frame is for this. Most insurance policies have a start time and an end time for it. A lot of them are things like 3 days. It has to be shut down for at least 3 days for the coverage to trigger, because they don't want to, they're not paying for, your business is down for a day or two, that kind of stuff. So we've got definitions within the policy of the resumptions of operations, the period of restoration. So let's go through those. We will reduce the amount of your business income other than extra expense to the extent you can resume your operations in whole or in part by using damaged or undamaged property at the described premises or elsewhere. Extra expense lost to the extent you can return operations to normal and discontinue such extra expense. Guys, this is what I was talking about when I said they can move the stages to the warehouse and continue those operations. Maybe they're not as profitable over there. It doesn't look quite as nice. They're not getting as many people as they used to get. But the carrier would be reasonable in saying, we're going to reduce your business income payment because you could or did have an opportunity to run your business in some part, in some way, somehow. Hopefully that all resonates. The period of restoration. often one of the more contested aspects of a claim, especially in today's market. And I think I actually wrote that, today's volatile construction market on the next slide. It begins 72 hours after the time of direct physical loss or damage, or immediately after the time the direct physical loss or damage immediately after the time of direct physical loss or damage for extra expense coverage caused by or resulting from a covered peril. And it ends on the earlier of the date when the property at the described premises should be repaired, rebuilt, or replaced with reasonable speed and similar quality, or the date when the business is resumed at the new permanent location. Let's break this down into layman's terms. You've got to take steps to try and fix your property reasonably. And it specifically says in here, repaired, rebuilt, or replaced with reasonable speed and similar quality. But there are some things that are outside of your control. Supply chain issues after COVID was an amazing example of when the things slowed down outside of the control of the insured, and that should extend the period of restoration. It does not mean that you can just sit on a payment for 3 months and apply for a permit after the fact and think that those 3 months are going to extend your period of restoration. You've got to move with some speed. Just because you get busy doesn't mean you can just ignore a claim and getting things moving. So make sure your clients are aware. You guys need to be, just because you're getting paid right now from the insurance company doesn't mean you can sit on your hands. You got to keep it moving. Period of restoration does not include any increased period required due to the enforcement of any ordinance or law that regulates the construction, use, or repair, or requires the tearing down of any property, or requires any insured or others to test or monitor, clean, remove, treat, detoxify, blah, 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 for pollutants. This expiration date of this policy will not cut short the period of restoration. Some important aspects of this. I'm running low on my time, so I'm rushing through a little bit, but important aspects are if you've got code compliance requirements that extend your time that you need to do work, it's not automatically covered under this. However, big however here, guys, big. If you've got code coverage, you've still got an opportunity to get this coverage, this time period paid for as a result. So just know that you can make that fight. Also note, if your loss happens in your last policy period month, doesn't mean you've only able to get this coverage for a month. You've got it for the entire policy limits time period for the claim. So your policy expires next month, property burns to the ground, and you've got 12 months of business income coverage. You could still collect for the 12 months, even though it's after the policy has already physically ended. All right, questions. As always, when you guys sign up, I try to put every single question in here to address. It's one of the benefits of replying with questions is you can make sure, even if it is unrelated to this loss, what happens. There were actually a limited number of questions on this one. I think there's 3 of them. And you're going to see as you read through these that I've addressed them, so I'm not going to drag them out. If you guys have any additional questions, please be sure to put them into the chat. So how can a business function after a disaster? And they give a summary of what happened. Guys, this is what business income coverage is for, right? If you can't function after a loss, if there's even just a drop in the business coverage, you have, or in the business income, you have coverage for that. You've got an opportunity to make payments or to receive payments as a result. That's why it is there. Your job is to just document it. If you hit problems like this person did about the carrier refusing to review documentations or tax returns, or they're fighting you on how fast the property should be built, I mean, that's what you're there for. And if you hit a wall, you can give me a call anytime, and I'm happy to help. What expense I think that was probably supposed to, I just copy and paste these, not my text. Constitutes and what expense does not. How does employee salary factor into this? I think we've hit both of these, so I'm not going to spend much time. But really the question I'm going to remind you comes down to, is it an expense that is intended to shorten the period or shorten the expense for business income loss? So if it mitigates that expense, it's considered an extra expense. How do you handle projections for year-over-year growth? So I didn't really hit on this in that area, the complications slide. But the truth is, if you just have a growing business, right? It's not that it's a new business. It's not that you've got a plan for expansion, but things are just going better. Year after year, you continue to grow. That is something that your forensic accountant will take into account as part of the process. If you've had 10% growth for the past 3 years, it's reasonable and likely to expect another 10% growth in the upcoming year. And that's something that can and should be paid for and accounted for in your loss of business income expense. What is the typical timeline for processing a commercial property claim? And what factors can cause delays in the settlement process? This was the last question that we had. Commercial claims are more complex most of the time than residential claims. So they'll usually take longer. Things that will delay it are beyond just the carrier doing things like switching adjusters and kind of their what I'll call tactics to delay claims. It's usually in not having the ducks in a row for the client. So you make a request for the tax returns for them when they're requested from the carrier a month after the loss. They say, oh, it's going to take, I got to figure this out. I've got to take time to talk to my accountant, get everything together. That's going to slow it down. The best thing you can do, guys, I can't stress this enough. Best thing you can do is at the very beginning of the claim, prepare your client for everything they're going to need to get from day one so they can start that process from the beginning. There is no reason, if you have a loss to a commercial property, that they should only be requesting their tax returns a month later. It shouldn't happen. You should let them know, get your tax returns in order, get your financial statements, get all of it now so that when we need it to get to the forensic accountant, we've got it. That is the best thing you can do for speeding up this timeline. And of course, working with the carrier to form timelines for the adjustment of the claim ahead of things actually happening can also be beneficial. All right, I finished with 2 minutes to spare. I try to keep these things under an hour. I really thank all of you. As always, here's my personal information. I'm excited for anyone who's stuck around long enough to listen to this part of it to say we have new software in our office that next month we're going to be implementing that will give updates to clients and public adjusters as to the status of their files and make me more available for communications. Communication is my weakest point. I know it is, and it's just because I spread myself too thin, but I'm working really hard to fix that, as I have been for probably years now. But I'm going to be doing a big announcement about that for adjusters, so I want you to know that that is in the works. As always, thank you guys so much. We can't do this without you, and continue to do your best to advance this industry and being the good guys in this fight, and not the ones that are giving a bad reputation for any side. We work towards the same goal: a truthful and honest response of coverage for these clients to get paid for what they are owed under the policy. So let's make sure we all push for that. All right. Thank you so much, everybody. Take care. Have a great, great weekend.